Between 2008 and 2015, the 258 profitable Fortune 500 companies paid an average federal income tax rate of 21.2%. Of course, the corporate tax rate during this time period was 35%, but 21.2% is still a significant amount. However, at the same time, 18 Fortune 500 companies were able to completely avoid paying federal income tax. So how did they pull it off, and what are the other companies and us missing? Well, starting off, the easiest way to avoid paying taxes is to avoid making money in the first place. After all, any percentage of zero is just zero. So if you make no money, there's no taxes to pay. Now, companies aren't going to just settle with making no profits simply to avoid paying taxes. With that being said, most rapidly growing companies don't make any money and thus don't pay any taxes during their growth. This is not inherently a problem. As long as these companies are truly investing in growth, hiring more employees, and contributing positively to the economy, this isn't bad at all. At the end of the day, all of this money will simply go towards the salaries of new employees. However, the problem arises when companies artificially create unprofitability or lower their profits. One of the ways companies used to do this was by paying out most of their profits as salaries to their executives. For instance, let's say Apple profited $10 billion last year. They could turn around and pay their executives $8 billion and say that they only profited $2 billion at the end of the day, and this is how much they would have been taxed. But this loophole has been patched. Well, kind of. In 1993, Congress attempted to close this loophole, but it wasn't very effective. They did cap tax benefits at $1 million per executive per year. However, there was and still is no cap to performance-based compensation, or basically stock compensation. And top companies make sure to take full advantage of this. For instance, Alphabet CEO Sundar Pichai made $242 million last year, out of which only $2 million is in cash. Similarly, Apple CEO Tim Cook made $136 million last year, out of which only $10.67 million was in cash. Of course, for companies profiting tens of billions per year like Apple and Google, writing off a few hundred million or even a few billion as executive compensation is just a drop in the bucket. But for rapidly growing companies with little profit to begin with, this strategy is very effective in entirely wiping out the tax bill. For instance, Tesla recently awarded Elon Musk $700 million in stock compensation. On top of this, Elon Musk receives 1% of Tesla for every $50 billion increase in market valuation and the relevant performance metrics. And for a company that's only net profiting a few $100 million per year, I think it's clear how this can be really beneficial. Moving on, we have the corporate malfeasance deductions. If you or me get a parking or speeding ticket, we won't be able to write these off on our taxes. However, many corporate violations are tax deductible. Some notable examples of these advantages are with Bank of America and Exxon. After the financial crisis of 2008, Bank of America was charged for unfair foreclosure policies. Though Bank of America had to pay up for their predatory practices, they were also able to deduct this off of their tax bill at the end of the year. Similarly, I think we all remember the Exxon Valdez oil spill. After the disaster, Exxon had to pay a hefty $1.1 billion to settle all the property damage claims. However, at the end of the year, they too were able to deduct this expense from their taxes. Next up, we have bank bailouts. If companies are losing money and their investors are backing the losses, then I think we'd agree that a tax break is acceptable. However, this becomes a bit shady when companies lose money and the taxpayers stomach the losses. But even here, it's understandable if the bailout money is used to protect tens of thousands of jobs and keep the company afloat. But where it gets bad is that companies can still write off these losses in future years. For instance, Let's take a look at the airline industry today. The government has given them tens of billions of dollars to stay afloat. Delta was burning through $50 million per day at the end of April. For our example, we'll say that this sustains for 100 days, and then Delta suddenly becomes profitable again, profiting $25 million per day. Obviously, in real life, they would go down to losing $40 million a day, and then $30 million a day, and eventually they'd work themselves back to profitability. But that's okay, as that's not relevant to what we're trying to show here. So anyways, in the first 100 days when they were losing $50 million per day, they would lose a total of $500 million. But this is where Uncle Sam comes in. The federal government happens to give Delta the exact amount of their losses at $500 million. So at the end of the day, Delta actually doesn't lose any money during the fiasco. But despite this, they can claim their $500 million loss on their next $500 million of profit, meaning that they don't have to pay taxes on the next $500 million they make. Considering that Delta only gets back to profiting $25 million per day, which is less than the amount that they were previously losing per day, Delta can stretch out these losses and not pay taxes for the next 200 days. So really, Delta didn't lose any money in the first 100 days, and they were able to avoid taxes for the next 200 days. This is precisely the strategy that most airlines will use for the next several years, and what many banks used for several years after the financial crisis. Anyways, finally, we of course have offshore tax loopholes. Yeah, many companies are established in such tax havens to avoid taxes altogether. But one doesn't actually have to be established there to reap some of its benefits. When companies make profits overseas, these profits are not subject to US income taxes. This law was established to encourage companies to expand internationally and reward them for doing so. And it makes sense. If you produce a car in Germany and sell it to a German, you shouldn't have to pay US income taxes on this profit. Sure, you may be using intellectual property that was developed in the US, but for the most part, this law does seem fair. However, this has led to companies developing some pretty sneaky ways to abuse this law. Companies started to register all of their intellectual property, including patents and trademarks, in low-tax nations. Let's take Microsoft for example. If they develop Windows in the United States and sell a copy in India, sure, they don't have to pay US income taxes on that. That's okay. But here's how Microsoft abuses this law. They go to a no-income tax zone like the Cayman Islands and establish a company called Microsoft Cayman. When they patent their new software, instead of getting a patent in the US for Windows 12, they patent it in the Cayman Islands with Microsoft Cayman. Now, Microsoft Cayman is the owner of Windows 12, and any other company trying to use Windows 12, including Microsoft North America, has to pay royalties to Microsoft Cayman. At this point, when a customer in the United States buys a copy of Windows 12 for $100, let's say Microsoft profits $50 a copy. So Microsoft North America should profit $50 from this sale. But unfortunately, Microsoft North America didn't create Windows 12. Microsoft Cayman did, and they charged some hefty royalties of $45 for each copy sold worldwide. Thus, Microsoft North America has to pay Microsoft Cayman $45, and Microsoft North America only profits $5 per Windows 12 copy sold within the US. This doesn't affect their bottom line whatsoever, as both Microsoft North America and Microsoft Cayman are Microsoft companies. Thus, their financial report for investors is not affected. However, they only have to pay taxes on $5 instead of $50. This sounds exaggerated, but this is exactly what's happening with Microsoft. For every dollar Microsoft makes in the United States, they send 47 cents to Puerto Rico, because we all know that it was Puerto Rico that created Windows and Office and Xbox and everything. Obviously, it was the 10 employees working at Microsoft Puerto Rico that are the powerhouse of Microsoft. The other 160,000 employees worldwide just get fat welfare checks from Microsoft, because Microsoft is so nice. Jokes aside, you get the point. In the end, all of these loopholes cost the US government between $100 and $200 billion per year. But don't get too worked up here. Giving this money to the government wouldn't really do anything, as it's not like they follow a budget anyways. What do you guys think is the solution to this conundrum? Comment that down below. Also, if you guys thought this video explained these loopholes well, then make sure to drop a like and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.